Welcome to 3 smart ways to combine infinite banking with wealth building. This is, I think, my 4th in a series of live streams here on LinkedIn. And so today I want to talk about just 3 different sort of general areas that you can focus on when it comes to building wealth and incorporating the system of a particular type of life insurance policy that we call infinite banking concepts. So do you feel like you're constantly missing out on opportunities to grow your wealth? And what if I told you there's a way that you can finance big purchases or investments without relying on traditional banks? It's called infinite banking concept. And today I'm going to break down these different strategies and approaches depending on where you are in certain levels. Everyone's in a different place when it comes to their financial situations. Some people are making good money, but they have a lot of debt. Some people are making good money and have no debt at all, or they have debt that's working, what we call good debt, like rental properties that are bringing in cash flow, that kind of thing. So if you're ready to take control of your finances, I've got a free resource for you that you can access called 3 Critical Reasons Become Your Own Banker. It just has a couple of it's a quick little checklist on some of the things I'm going to be talking about. So let's go ahead and get started. So the first area that I like to think about when it comes to this is sort of at the sort of base level, and it's where my wife and I started, and I think I might have mentioned this before, where we had some money that came in that was available for us to put to work. And in our case, what we had was a chunk of money from my father-in-law having passed. So that's how we got started. So it doesn't really matter how you get started. The idea is that you get started one way or the other, and whether it takes, you're able to have set enough money aside inside a new whole life policy that's set up the right way with the right companies, and you can get started on the strategy. Some people, it takes a little longer. It might be a couple of years before the cash value inside the policy is large enough where they can put it to work. In that case, it's more of a savings and liquidity strategy for their future. So, and then it really depends on where you're at. So the first idea is the idea of turning debt into wealth, which I did talk about on my last live stream. And the idea with that is that money that was maybe sitting in a savings account or money that came into you, like in our case, part of an estate being released from my father-in-law, wherever it comes from. You get started on the policy, doesn't have to be huge, and there's some chunk of money that you can put to work. So I'll give you an example of a client of mine who had a fairly modest policy of $10,000 a year in premium going into this whole life policy, annual premium. So less than $1,000 a month if you stretch it out that way. Not huge. And of that 10,000, roughly 7,000 of it is available capital to use right away. And then the following year, another new 7,000 is available. And then over time, that expands out and gets larger. So just in her case, this is what she did. Actually, the first thing she did was she took a loan out from her policy to get more crypto. I think I might have mentioned this before on a previous live stream. But the next year, she realized that she still had outflow of money in the form, the only debt she had was a car loan. And it was an interest-free car loan. So she thought she'd done good by that, which she had. She was able to get one of those interest-free auto loans. And she was just paying $300 a month on it. And I pointed out to her that if you have reserves in your policies and you have outflow of money, whether there's interest tied to it or not, it's a good idea to look at that. So we looked at it. It made sense for her. She took a loan from her policy and paid off the auto loan. And then what I coached her on doing and educated her on and taught her was the natural sort of inclination might be to just forget about it. Look, it's paid off, so I don't really, I'm not going to worry about it anymore. And what I suggested she do, and she did, says that $300 that was going towards the financing company, never to be seen by you again, $300 a month. regardless of whether it was interest free or not. That's not money she's ever going to see again, because cars don't work that way. You can't sell it and make a profit on it. And instead, redirect that $300 a month back into her own system, pay the policy loan off to the insurance company, which just creates new cash value that she can use for the next time she needs to use money. So that's one example. It's just think about it this way. It's just $300 a month that was going away. She'll never see again. Now, because she built up a little reserve, she's able to pay off that debt. No more $300 a month going away from her. It's coming back in her own system to be used whatever she needs for next time. Okay, so that's example one. And the example number two is I'll go with larger purchases. So again, I can use a car example is a really good one as well. We did that in our case. We had enough in our policies. We have a series of policies now where we had enough money in the cash value where we could, when it came time to buy a vehicle, we were able to tap into it and purchase the vehicle for cash. It wasn't really cash, it came out of our system. And again, the same kind of thing where in this case, since we didn't have an existing loan, what we did was we said, okay, had we taken a loan out on this car, this is roughly what the payment would have been to the auto financing company. And instead, we just redirect it and put it back into our own system. So that's an example of a larger purchase, kind of an option that a lot of people who are using infinite banking, if they don't have debt or they have dealt with their debt strategy and they just, things come up, you need to buy stuff. It could be new vehicles, it could be washer and dryer, it can be all kinds of things. Once you get your system up and running, you can then have the ability to purchase those larger items yourself and in a way self-finance. And remember, when you do take loans from the insurance company, you don't go on a payment plan with them. They charge a simple interest. It's pretty low. It's anywhere from 5 to 6% typically, depending on the company. They don't put you on a payment plan. So they're unstructured loans, which is unique. You think about any kind of loans you take, they're typically structured. You take the loan out, it's amortized, you have to pay this per month for this period of time, and you miss a payment, you get at least penalized. If you miss more than one payment, they can come after. If it's a car loan, they can impound the car. That's not the case with these loans from the insurance company, where it's collateralized by the value in your cash value, which is guaranteed. So that's an important distinction. And you don't have to pay them back either. I don't know if I mentioned this before, the interest that accrues on these policy loans from the life insurance companies, if you just pay the interest only on the loan, and I've done that several times in our policies where I'll get an annual statement for my next year's premium, and it'll say, hey, you owe, let's say it's 10,000 premium for this policy. Let's say it starts January 1st, for example. They'll also have it saying, hey, there's also a couple $1,000s in interest that you owe on the outstanding balance of the loan. And even that, you don't have to pay it back. If you do, it's just money that gets reattributed and reassigned to your cash value. So you don't actually lose it. So I always, as much as I can, and I've only missed once or twice where I didn't at least pay the interest on the outstanding loan to the life insurance company. It's best if you do, because it's just money you can use again. So you don't actually lose out on the interest payment in these particular types of contracts. And some people never pay the loans back. They may opt for other things. If you're going to really be an honest banker with yourself, it's best to do that. And you don't have to. It's really up to you. So the third part I want to get into, and this is a great example. I have a client who is a veterinarian surgeon, and he makes good money. And this is a few years ago, and he started a policy with me where he was paying about $50,000 a year in premium annually. And this is important. So the minimum that he had to pay for it was $20,000, and the max he could pay was $50,000. The difference of that $30,000 is those are restrictions that are put upon us by the IRS. With these whole life insurance policies, you can't put too much cash in too early, or they lose their tax advantage status. So we have to set them up the right way. In his case, 20 of it was what's called the base premium. That's the annual required premium that he had to pay to keep the policy going. And 30 of it was an additional that he could add in. He didn't have to, but he had the ability and the right to do that. So he had no debt at the time. So he paid his first $50,000. Year two, did the same thing. There was really nothing, there was no immediate place to put that cash value. So by year two, he had over $60,000 in there he could do something with. And there just wasn't, in his case, nothing really to do, so, which is fine. In that case, it was just a savings and liquidity vehicle, just doing his thing. That money was coming in anyways. He could have put it into a money market account. In fact, he was using a money market account before, which is fine. It's just understand that even a high yield savings account, you put your money in there, it's taxable. So even you'll see ads out there for high yield savings accounts at 5, 6, 7%. That's gross. That doesn't mean that's what you're going to get. That's gross yield on you having that money in there. And of course, there are fees involved in that. And also, if you take the money out of there, then it's gone. You may recall from a prior session that the money inside your cash value in these whole life insurance contracts, when you access it, because you're taking loans from the life insurance company, the guaranteed 3 or 4% inside the cash value keeps growing. You don't tap into the principal. So it's very different. So he was just redirecting his 50 grand per year. And in year three, he actually was remarried, and his new wife's a very savvy business person, and they found a kennel, or an animal, I guess it's kennel for lack of a better term. There might be a better term for it now. A place for animals to board, like a boarding facility for dogs and cats, I think. And it was great business, had maybe 20 employees, not far from where he was operating as a surgeon. And there was a deadline on when they needed to come up with $100,000 to close the deal on the new business opportunity. So he called me, and the timing was such that he had another $50,000 premium coming due on his policy. And there was only like a week wiggle room. So he called me and said, "Hey, what should I do? I could either keep this 50 that I have set aside for the premium on the policy and use it, and then just take a loan out of what's already in there." And he could have come up with 100,000. And I said, "Well, no, do this instead. Pay your premium, and then a few days later, you can take a loan out from your cash value and then use that 100K to close the deal on the business." It's a much better way to do it. It's almost a form of paying yourself first. So by putting that money into his system first and then tapping into it to close the deal on the business, with just a much more advantageous thing for him to do than just paying cash for it. And the other interesting thing too is I want you to think about this. Remember, I said in his case it was $30,000 a year was that extra that he could put into the policy that goes right into the cash value. So after three payments, annual payments, you would think there's about 90,000 of available capital, because remember, he had not touched it to this point. Actually, there was 120,000 in there that he total gross, and he could tap into about 150, 110. So what happened there? So there was 90 in there that he put in, yet there was an extra $15,000, no more than that, $25,000 of capital. How did that happen? That's the growth inside of these things. That's the dividends. These are dividend paying whole life insurance companies. That helps the whole thing grow. So he actually had an extra $25,000 of tax-free money that he could tap into in his cash value. Took the loan out, closed the deal on the business, and the rest is history. And that's just a killer business. I forget what he told me the cash flow was on it. And it just worked out beautifully for him. So just an example. And this is similar to what people like Walt Disney back in the day, last century, tapped into his whole life insurance policy to help fund his first theme park. When the banks, I forgot to mention with my client, the banks at that point has said, we're not going to give you another $100,000. You're tapped out in our eyes. So just another example of why you want to put as much money as you can into these whole life insurance contracts, because you get to make the call. Your money, your rules. So I'll end it there. Thank you so much. Merry Christmas to those who celebrate. Happy holidays. Happy New Year. I'll pick up again after the New Year. I think the Friday after New Year. So be well. Thanks.